Hello everyone, hey, welcome to Macro Cafe episode 11. This is your host, The Cowboy. I haven't seen you guys in a couple of weeks in this macro field. And let's get started. We have lots to talk about. Bitcoin would be the first, and we'll move on to oil and gold, the S&P 500 and dollar. We'll take a look at the yields and some cool relationships there, with the Federal Reserve and the markets overall. I got some interesting charts to show you. So, guys, you can find me on Telegram at the Elliott Wave Cafe. There's a public chat where you can come and show me charts and things, that you're interested in and you want me to look at. There's a premium room, for a fee. I'll talk about that at the end of the video here. And then also on Twitter at Elliott Cafe. So, let's get started. Bitcoin continues to look pretty strong here on the monthly charts. The RSI is up here into the overbought territory, but it continues to kind of trend higher. The candle for the past month, in the month of April, was, a little concerning. And, if we're not kind of canceling this candle by a move to new highs, there is a little bit of a risk to the downside. So it's very important what happens in the month of May and how we're closing this. If we're able to make new all-time highs, I think this doji candle will get invalidated, and that's an important signal. Otherwise, it's a big pause in this uptrend. In terms of accounts, which I'm not going to go into, I've done a video last week on Bitcoin and Ethereum in terms of counts, but I think we remain in this larger cycle third wave. So you have a wave one of these, December 2018 lows, then a pullback in a second. And then you go in another 1, 2 in here, and you're doing a larger third wave primary. So 1, 2, 3, 4, and 5 to complete a larger third wave cycle. And that should take us maybe towards 100,000, 120 before, we pull back in a more meaningful way. So this is kind of what I'm seeing in Bitcoin. Now, going and taking a look at the moving averages and on the daily and the weekly charts, they continue to look pretty solid. So up here on my right, you can see that we have, this bullish engulfing candle. And, this kind of tells me that the market is about to move to the upside, right? That's a bullish indication of the fact that, we tried to sell off, but we overtook that sell-off, closed, at the prior open, and then we actually moved higher, and we're moving above the 50-day moving average as well. So that's a good sign. Also on the weekly charts, we have a very, very similar pattern, which looks interesting. Now, going back and taking a look at the monthly, before I switch over to oil, I wanted to, to keep you, to give you a little bit of an outlook on this RSI. So, you look at this thing and it's at about a 90 right now on the monthly. And if I go back to 2017, a similar level at 90 was maybe back when Bitcoin, let's say, was somewhere up into these levels, right? About 25 to 3,000. And look how much farther it actually went. It actually exploded up into 20,000, with the RSI maybe reaching 94 or 95. All the while this thing, went up like 10 times the price, right? Or 8 times. So, there is a chance that this could still happen up from these levels. So it doesn't mean that just because we have an RSI at 90, we are super overbought. This thing can continue to climb higher. And if it's doing it kind of at a steady pace, I think that's, that's quite interesting. And I'm not ready to, to throw, a big cold shower on this price action just because the RSI is at 90, right? It can continue to move. And until you start to get a larger divergence, things are fine. All right, so that's on Bitcoin. Let's jump over and take a look at the, the rest of the field here and kind of start with oil. This is a chart going back to the 80s, right? So you have almost like 30 to 40 years price action looking at the oil markets, WTIC, major sell-off, right, during the pandemic in here back in March. And since then, we've recovered quite a lot. Now, it's all the talk of the inflation, all the talk of the reopening of the economy, and obviously oil benefits. We are approaching, important resistance levels. We've talked about it in a couple of, other videos prior to this, and we were expecting this pullback. But listen, oil continues to act strong in here. I think it's going to challenge the 70, 80, maybe even the $100 level in oil. I mean, the next important level is the 75. And if I take a look at the charts, and you can see also the, this channel, the moment we kind of break above this channel, all bets are off, and you can get, to $150, $200 oil, pretty quickly. Let's see in here. In terms of the weekly charts and patterns, the count kind of remains impulsive from these lows, either in an ABC, which is if the case we're supposed to sell off, we're supposed to sell off and we're not. But if it's a 1-2 in a bullish setup, this thing is going to continue to rip to the upside. Actually, a lot of the other commodities are moving, while oil is actually kind of holding back a little bit in here. So the moment this gets unleashed, it's very possible that we're going to find ourselves at $100 oil very, very quickly. So I'm continuing to watch this as a 1-2 alternate with another 1-2 in here with a push to the upside. If for any reason, this wave C of this 2 is not happening, I would have to modify the count slightly and consider this move a flat in an ABC for a second wave up into these levels. That's a wave 1 of the lows, and then we continue to push to the upside. So my outlook in oil remains bullish. I think there's a lot of signs there that continue to benefit the energy market. You can see, actually it's one of the strongest sectors out there, and the money continues to pour into this reflation opening trade. And the trends, things that are moving up, continue to be moving up, right, until something knocks them off. But for right now, this continues to look good. Let's also take a look at gold. So gold, it's been in a big correction since the summer of 2020, and we were talking about this even a couple of weeks ago, even a month ago, right? We were waiting for this decline to finish into some sort of a fourth wave pattern, and since then we've rallied, especially on Friday, up here at about 1830. And we had a level in here that we considered that's important, this 1816 level in terms of a count, that I said that would be the first level that will start to pique my interest in a return to a bullish outlook in gold. Now, if this is going to have traction or not remains to be seen. There is another trend line that's coming from those highs that's starting to get challenged around 1850 to 1860 in gold. So we're still a little bit premature and early, but I think the signs are there that gold could start to embark in a larger fifth wave of this larger third, of a much larger bull market. The RSI is kind of pushing off the lows, and this is an older chart, right? You're going in here. This is about a month-old chart, so right now I'm sure it looks a little bit better. And this is kind of going back a couple of weeks ago, right, when we were approaching this 1816. And that's back from April 9. So all the while we were watching this fourth wave, and we were continuing to monitor, the bounce of these levels. So, with this climb up here to 1830, we're still hitting now the 200-day moving average. This is a weekly chart, so, that's a 50, but a similar story. And, the RSI starts to look good. You almost have like an inverted head and shoulder in here into the RSI. And I think, let's see if we can get some momentum. But gold starts to look good again. Right, it stopped going down, and we'll see if it's going to start to get more of an impulsive move. The yields are starting to rise, but the negative yields, the real yields are starting to pull back. Right, the inflation is starting to rise, the real yields are pulling back, and gold is benefiting. I'll show you a chart a little bit later. But yeah, this count remains very much valid, and we're looking for a break of this trend line and a move higher to new all-time highs in gold as we're pushing out of these levels impulsively. This is a relationship here with copper, right? This is a chart that by now you're familiar with. This line in blue, it's the copper-gold ratio. The more this continues to move to the upside, the more bullish things are, the more the markets are excited about a risk-on environment. They continue to favor base metals and copper and building materials over more of safety trades like gold and silver and some of the other ones. And this ratio continues to be very well it's trending, and it's mimicking pretty much, right, the S&P 500. The correlation, it's there, and as long as this pushes to the upside, the S&P 500 will continue to follow. Here is a performance since the beginning of the year in some of these base metals. You look at copper up almost 35% on the year, while gold is still negative, about 3.37. Silver, it's the one that's acting a little bit better. It's a little bit better performer than gold, and for that you can also look at the silver gold ratio and see it's in favor of silver still, and that's up about 4%. And then you have platinum in here that's been pretty much flat but still a good performer, up 16%. But copper is ripping to the upside. Copper is telling you that people prefer and investors prefer risk. Guys, take a little bit of a break, have a sip of coffee, maybe an espresso. Don't forget to subscribe and like this video, just so we can kind of continue to rise into the YouTube rankings in there, so more people find us and see us, whoever is interested in macro, not just in cryptos. So yeah, take a break, subscribe and like, and we'll keep going. Here we are on the yields. So this is a look pretty much at the yield curve across, the yield rates across the spectrum here. And you start from let's say from the 3 months treasury yields, and then you continue to move higher to the 6, to the 2-year, 5-year, 10, 20, and 30. And you can see here these are very, very low. The Fed fund rates, it's still giving you nothing, right? It's basically near zero. They're pretty much telling you they're not going to raise rates until 2022, maybe 2023, who knows? It's data dependent. Market will force their hand, and there's been talk about, hey, maybe them starting to taper towards the end of the year, but nothing really came off the Fed just yet. And if anything, proves that they're going to continue to stimulate the economy is the job reports that we've gotten on Friday, which was very, very weak, and kind of told us that the economy is trying to recover, but there's still going to be bumps along the way, and this kind of justifies the Fed action going forward. But if you look at the trends in yields in here, you can clearly see that as when we've been going up for quite a while, but now we have been correcting, and this is that kind of corrective pattern, that bullish flag that we're getting back in here, and the markets are starting to coil back higher in here, which tells me that not long before we actually start to make new highs in here into the yields. So pay really good attention to this pullback, because as soon as this is done and you're starting to challenge some of the trend lines, there's going to be a rip to the upside again into the yields. And it's just a matter of kind of how fast and how quickly that happens, if it's going to put any pressure on the stocks overall. But if it happens at a gradual pace, I think we're good. Also, this kind of shows you that you have no inversion, and that they're pretty much, the yield curve continues to be on a positive slope, with the longer end of the yield curve giving you the highest yield, and then with the lower end giving you the lowest yield. So this is a good sign for the economy overall. And then, just a quick look at the chart of the TNX. This is the 10-year yields in here. Again, just kind of pulling back. In terms of a count, it's not super clear, but this is impulsive. It could be a C wave, or it could be wave 3, 4, and 5. I would continue to prefer more of an impulsive look, since we've done a pretty big base in here. I don't think this is an ABC, and we're not going to see, rates being, selling off too aggressively in here. I mean, if they're going to come back, maybe retest 120, 130, that's totally fine, but anything deeper than that, I don't think it's likely. So yeah, we continue to stay bullish on yields as well. Here's a look at the chart that I promised you regarding the real yields. We've looked at that a couple of weeks ago as well, and here you can see how the the real yields are pushing back. They're getting even more negative in here, right? So why in the world would you want to keep the money in the U.S. banks when you're basically losing in here aggressively? So gold reacts to that and is pushing higher as the real yields are moving lower. So just another look at this that continues to be a pretty good relationships here, almost 100% inverted. So let's continue to keep an eye on that. S&P 500, it's continues to be in a strong trend, guys. I've been talking about this for months on end, and there's really no signs from the stock market that it wants to falter in any way. You have some extreme sentiment readings, that you can kind of pick and choose which ones to look at. But overall, the price is making new highs. And as long as this moves up into the right, to me, that's the simplest, more purest definition of an uptrend. You've done a major correction, last year, and you're back to a bull trend. And as long as some of these major levels continue to hold in here, I have no reason but to continue to look to the upside in a 1-2 and the beginning of a larger bullish market. And the signs are there that the stocks are making new highs. I mean, on Friday you've had one of the largest increases in new all-time highs. I mean, in new 52-week highs into the S&P 500. 167 of the 500 stocks into the S&P made new 52-week highs. The prices below the trend 10-day moving average of these new highs, it's at about 104 right now. So in average, right, 104 stocks are making new time highs. And as long as this line points higher and it doesn't diverge with the S&P 500 pricing, you have to stay bullish. Similar story with the advance versus declines, right? They continue to favor a move higher. Again, if you look at the advanced decline line as well, I mean, similar to what I showed you before, it's a very important metric to kind of have, in the back of your mind, and to kind of, every time you kind of have doubts about the stock market, just continue to look at this line. And this telling you that, there's more stocks that advance than stocks that decline. And this is a bullish market, as bullish as it gets. The RSI, it's, pretty much trending back in here. And to me, this continues to point higher. We're going to continue to stay with that until we have a reason not to. All right, so we're buying stocks on the dips. We're buying SPX. We're buying Dow Jones. Those little blips that you get on the market where Janet Yellen comes and says that, hey, the rates are supposed to rise, buying opportunities every time they sell them, because they're going to come back and retest those and rethink those statements. And looking at the dollar, right? Dollar is starting to attack the lows in here, and it's getting very, very weak. We've been all over this weakness in the US dollar onto this rise. Talking about the 200-day moving average offering resistance as it returns, lower in here. We've broken, pretty good trend line that we have from these lows on Friday. You can see back in here. I will see if this is going to be just a little fake to the downside and we're going to pull back, but this could be a very, very serious development. And as you can see into the euro dollar as well, right, this trend line coming from the highs, it's been violated, and euro is trying to, this looks like you have a left shoulder, right shoulder, and a head in here. And if we're kind of getting back above this level, maybe we're going to come back and retest it quickly, and then we're going to be off into the races. So keep an eye on the US dollar, because I think it's going to get weaker in here. It's structurally, it's in a weak trend. You can look for the last 40 years, we've been getting weaker and weaker into the dollar. You could say that this is pretty much flat, but it's in a downtrend. Easy slope, I might say, but it's I think we're approaching in here very important levels, and these are going to start to get challenged, right? So you have one of the trend lines that is going to be here, and then you kind of have this move that's being challenged right now. So this is this is something to watch, because you kind of have this channel. And we've talked about this when we kind of had this bounce, but the moment we're going to start to get towards these lows in here, about 87.5, and we break below those, then the next big level of support is right here near 80 into the US dollar. And I'm curious what's going to happen with the emerging markets and a lot of other assets if dollar really starts to get demolished on here. So pay attention, keep an eye on the dollar. Here is a look at the Dow Theory, where you have the Dow Jones Industrial Moving Averages, and then you have the Dow Jones Transportation. So you can see how the transportation is actually outperforming since March of last year, as people starting to kind of pile on this reopening and thinking that things are going to get much better. And sure enough, transportations are looking very, very good. You can see the ratio in here kind of diminishing, so it's in favor of transports. The industrials are starting to kind of chase it higher, right? So look at Dow Jones as well. But, as long as this continues to point to the upside, again, it's another indicator that we have no reason to think of any bearishness into the market. Sorry to sound so bullish, but all these indicators continue to point to the upside. And until they start to diverge from each other, or they start to, turn the other way and start to take some of the key levels, there is no reason to think otherwise. Here is another interesting chart that I wanted to show you here as I'm kind of winding down the video. It's something I've seen on Stock Chart. I think it was Bruce Frasner that kind of showed this chart in one of his videos. And, this was very, very interesting, because it kind of got me thinking of, how easy we kind of get disturbed into some of the daily talks and information that we're getting constantly bombarded with from CNBC and Twitter and all this other Bloomberg, about what's happening, and people, whoever tries to scare you the most, right, to get the more clicks and the more views. But if you look at this chart, right, and this is going back to 1987, and you can look at the periods that are kind of orange onto this chart. These are actually periods where we've had increases in the Fed funds rate, right? This is the moment where the Federal Reserve starting to their kind of tightening cycles. So you have a period of easing, and then you have a period of tightening. And this is what happens to the price, right? So as, for example, you can kind of go back here to 94. As they were actually tightening, right, the market was going higher. The moment that they're starting to ease, right, then you have, because they're anticipating a weakness and, they have their indicators, whatever, right? Usually they're behind the curve anyway. But as they're easing and they're cutting rates, right, the markets are selling off. And this is what happens. Then you go for a period of a flat market, right, as you're kind of forming a bottom. And then the markets start to get bullish as they're keeping rates, for months or maybe for a couple of years, whatever it is, at a very, very low levels. The market are starting to turn bullish. But then as they're starting their tightening cycles, the markets continue to rally, right, until the next cycle begins and they're easing again, right, like they've done prior to the financial crisis and during the financial crisis in here. They took them from 5% down to 0, and you've had the major sell-off, and then they kept them low for 6 or 7 years, 2009 to 2016, for 7 years of very, very low interest rates, which created the big bull market in here, right? They continue to rally. Not only that, they continue to rally into the tightening that the Federal Reserve did up there to about 2.5%, right? So only after that, we've done a little bit more of a spike, and then the COVID hit, and then they started to ease, and it was, the biggest kind of cuts, and the fastest cuts in history, possibly. And now we're, at the very, very low rates again. And who knows how long that's going to be, possibly for another year, maybe for 2 years, maybe for 3 years. We'll see how that happens. But what I'm trying to show you here, and it's exactly what Bruce was saying in his video, it's basically I'm repeating, don't expect the markets to sell off just because they might get into a tightening cycles. This could be at least maybe 5 years down the road before we're going to get a sell-off into the stock market. Because if they're going to continue easing or keeping the rates low, for another 2 years from now, and then it's still going to take another couple of years, once they start kind of, raising rates, right, or maybe 3 years of raising rates, the markets are still going to push higher into the next easing cycle. So you can look at the next 5, 6, 7 years of a bullish market, right? And looking at the S&P 500 and kind of the way, the way it looks, as I showed you before on here, right? I mean, this can continue to move, towards 6,000, 7,000, 10,000 into the S&P 500, right? Especially with the amount of money that they're printing and, the amount of bond purchases that they're doing and all this stimulus, right? So, I think if anything, this is one of the most important charts into my presentation today, and, just kind of save it and continue to monitor this chart. And then in terms of performance in here, guys, the S&P 500, it's a mere up 13% since the beginning of the year. Oil in here continues to be one of the best performer at about 34%. And then you have, back in here, you have the emerging markets, about 6%, 5%, along with, what's the next one in here? You have Qs, right? So just the kind of the tech sector. And on the negative side, dollar is pretty much flat in the beginning of the year, not doing a whole lot, kind of going up and down. And then gold is starting to gain a little bit of strength, but still at the minus 3%. And then bonds have been completely destroyed. They're the weakest performer at minus 11%. And then if I were to plot 2 more charts on here, it would be the chart of lumber and it would be the chart of Bitcoin. Lumber is, I think up 90% or 92% in the year, and then Bitcoin is up 94 or 95, 98%, I think. So, not even a point to put those two on the charts because those have been very, very good so far this year. So I'm kind of sticking with, not with a little bit more of a easier performer, right, than going to the best ones. Guys, I want to thank you for watching, and before I let you off in here, come and visit us at Elliott Wave Cafe. We're open 24/7. People, across the globe, we got kind of traders everywhere. They post charts, during the night, during the day. I have my presentations during the day, and daily videos on macro and coins and altcoins and Bitcoin. all this good stuff on there. You can find me on Telegram, and this is kind of what we provide in the Elliott Cafe. You can take a 7-day trial. It's free. Come and check us out, see what we do. There's a pro channel, a charts channel, trade alerts, what I trade live. We're long Ethereum right now. We've been long since we broke up at about 26 or 2700. We moved our stops to about 3100. Now our stops are about 33, so we continue to kind of gain a little bit of alpha on Ethereum. We're also long Bitcoin, and I place the trades there with the stops and the targets and explanations of the trades and all that. So if you want to learn about Elliott Wave, there's also a 7-hour course that comes with a 1-month subscription now, and it's you can take your time and learn everything there is about Elliott Wave. And then when you watch the videos and charts, then you can kind of put things into perspective and learn the strategies that we use, the entries, the stops, and all that stuff. There's a learning channel as well. There's a chat room where people chat all day long, and we have a stock channel as well where I kind of show you what I buy and might sell into my portfolio, what I'm thinking about this kind of macro trends and where I kind of position my money. Guys, thank you for watching. I'll see you in a couple of weeks. I really appreciate. Don't forget to subscribe and like, and maybe hit the notification bell here as I'm kind of closing up. And I'll see you next week for Bitcoin and Ethereum wave analysis, and then in a couple of weeks for the Macro Cafe. So talk to you soon. Bye bye.